Good day to my respected supervisor and lecturer and fellow students. My name is Tan Yiling, and today I would like to present my management study project entitled The Impact of Dividend Policies on Firm Performance Among Bursa Malaysia listed companies. This study examines whether dividend policies influence firm performance among selected consumer products and service companies listed on Bursa Malaysia. Dividend policy refers to a firm decision regarding how much of its earnings should be distributed to shareholders as dividends and how much should be retained for future investment and business expansion. This topic remains important because researchers have not reached a consensus on whether higher dividend payments improve firm performance. Malaysia provides an interesting context for this research because Business Malaysia has a market capitalization exceeding 1.1 trillion ringgit, while Malaysia's capital market reached approximately 4.2 trillion ringgit in 2024. Furthermore, the consumer product and service sector consists of 167 listed companies with a market capitalization of approximately 261.74 billion ringgit. Household consumption also contributes about 60.7% of Malaysia's gross domestic product in 2024. This factor makes the sector particularly suitable for examining the relationship between dividend policy and firm performance. This study addresses three major research gaps. First, previous empirical studies have produced inconsistent findings regarding the relationship between dividend policy and firm performance. Some researchers found that higher dividend payments improve firm performance, while others reported negative or significant relationships. This unresolved issue is commonly referred to as a dividend puzzle. Second, many Malaysian studies focus only on dividend payout ratio, while ignoring other important dividend-related indicators such as earning per share and price-earning ratio. The exclusion of this variable may result in specification bias and incomplete analysis. Third, most previous studies were conducted before the COVID-19 pandemic and therefore fail to capture the changing business environment during and after the crisis. To address this problem, this study incorporates the pre-pandemic period from 2016 to 2019, the pandemic period from 2020 to 2021, and the post-pandemic recovering period from 2022 to 2025. Providing a more comprehensive examination of dividend policies and firm performance. The study is guided by four research objectives. The first objective is to examine the relationship between dividend payout ratio and return on asset. The second objective is to investigate the impact of price-earning ratio on return on assets. The third objective is to analyze the effect of earning per share on return on asset. Finally, the fourth objective is to determine the influence of firm size and firm age on firm performance. In this study, return on assets serve as the dependent variable, while dividend payout ratio, price-earning ratio, and earning per share are the independent variables. Firm size and firm age are included as control variables. To provide a strong theoretical foundation, this study integrates five major theories. Agency theory explains the relationship between dividend payout ratio and firm performance, suggesting that higher dividend payments reduce agency conflicts and improve managerial efficiency. Signaling theory explains earning per share, where stronger earnings send positive signal about future firm prospects. Asymmetric information theory explains the price-earning ratio, as market valuation often reflect investor expectation of future performance. The study dependence variable, return on asset, is interpreted through agency theory and supported by the resource-based view, emphasizing efficient asset utilizations and firm capabilities. The resource-based view also supports firm size, while firm life cycle theory explains firm age by suggesting that dividend policies evolve as firm progress through different stages of development. Together, this theory provides a comprehensive framework for understanding how dividend policies influence firm performance. This research adopts a quantitative research approach using secondary data obtained from audited annual report Bursa Malaysia, Yahoo Finance, and KLSE Screener. The sample consists of 10 consumer products namely Nestle Malaysia, Dutch Lady, Fraser and Leaf, PPB Group, Carlsberg Malaysia, Heineken Malaysia, Petronas Dagangan, Padini, Aeon, and CCK Consolidated Holdings. The study covered a 10-year period from 2016 to 2025, resulting in the total of 100 observations. The data were analyzed using EVIAS 14 software. To determine the most suitable econometric model, 3 specification tests were conducted. The trial test indicated that the fixed effect model was more suitable than poor ordinary least square. The Brice-Pagan-Lagrange multiplier test suggested that the random effect model was superior to poor ordinary least square. Finally, the Hausmann test confirmed that the fixed effect model was preferable to the random effect model. Because the firm-specific effect will correlate with the explanatory variables. Diagnostic tests further revealed that presence of heterosyndacticity, cross-sectional dependence, autocorrelation, and normality. Therefore, the final estimation employed the fixed effect model with wide cross-section clustered robust standard errors, which provide more reliable and robust statistical inference. Moving on to the empirical findings, the final regression model achieved an adjusted R-square value of 0.929663. This indicates that approximately 92.97% of the variable in return on asset is explained by the variable included in the model. Regarding the hypothesis testing result, dividend payout ratio was found to have a positive and statistically significant relationship with return on asset, with a coefficient of 0.063392 and a p-value of 0.0021. Therefore, the first hypothesis is supported. Price-earning ratio exhibited a negative and statistically significant relationship with return on assets, with a coefficient of negative 0.183182 and a p-value of 0.0002. Since the relationship is opposite to the hypothesis direction, the second hypothesis is not supported. Earnings per share demonstrate a positive and highly significant relationship with return on assets, with a coefficient of 0.082390 and a p-value of 0.0. Consequently, the third hypothesis is supported, and earnings per share emerge as the stronger positive determinant of firm performance. Among the control variables, firm size show a significant negative relationship with return on asset, while firm age was found to be statistically insignificant. The findings support several theoretical perspectives. The positive relationship between dividend, payout ratio, and return on assets support agency theory, suggesting that higher dividend payment reduce free cash flow problem and improve managerial discipline. The positive effect of earnings per share supports signaling theory, indicating that stronger earnings send favorable signals to investors regarding the firm's future prospects. The negative relationship between price-earning ratio and return on assets support asymmetric information theory, implying that high market expectations do not necessarily translate into stronger current accounting performance. Furthermore, the negative relationship between firm size and return on assets suggests that rapid asset expansion may reduce operational efficiency. The insignificant effect of firm age indicates that firm maturity alone does not guarantee better utilizations of assets. Based on these findings, several recommendations are proposed. First, corporate managers should maintain sustainable dividend policies that are aligned with the company earning capacity and long-term growth objectives. Management should prioritize improving earning quality because earnings per share was found to be the strongest contributor to firm performance. Second, investors should evaluate firm based on both dividend consistency and earning performance rather than relying solely on market valuation indicators such as the price-earning ratio. Finally, regulators such as Securities Commissions Malaysia should continue promoting transparency and high-quality dividend disclosure to reduce information asymmetry and strengthen investor confidence in the capital market. In conclusion, this study confirmed that dividend policy is significantly influenced firm performance among selected consumer product and service companies listed on Bursa Malaysia. Dividend payout ratio and earnings per share positively improve return on asset. Ratio exhibit a significantly negative relationship with firm performance. Earnings per share is identified as the stronger determinants of firm performance, highlighting the importance of sustainable earning generations The study therefore concludes that maintaining strong profitability together with a well-managed dividend policy is essential for enhancing firm performance. Thank you very much for your attention.